Hey everyone, this is Scott here again with a new video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in today's video, I'll be discussing the differences between index funds and ETFs, and then explaining which one is going to be best for you based on your own preferences and your level of involvement in the market. And if that sounds interesting to you, then please do me a favor and hit the like button on this video and subscribe to my channel. It would really help me out a lot. And so, as always, before getting started here, if you are interested in taking a deep dive into stock market investing as well as options trading, please check out my courses on Skillshare. I've been teaching on that platform for over a year at this point. In case you aren't aware, Skillshare is a lot like YouTube, except the content on that platform is geared solely towards the purpose of education in the form of online classes. And in my courses, you will see a lot of the detailed research and analysis that I have done using real stock market data, spreadsheets, graphs, and even computer programs that I have written to help simulate and prove the concepts that I am teaching. And I've dropped some links to some of the more introductory courses of mine in the description of this video below. Now, you will need a premium membership with the Skillshare platform if you want to watch my courses. But if you do sign up with that kind of membership, using the links provided in the description of this video, you will get an absolutely free 2-week trial. And during that time, you can watch all my courses on Skillshare for free. And then once your trial has ended, it's only going to cost you a few dollars a month to maintain that membership. And you'll gain access to all the future courses that I have planned going forward. And if you decide you don't like it, no worries, you can cancel before your trial is over and you won't lose a dime. But again, if you are interested, please check out those links and join the thousands of other students that have already taken my classes. And so now diving in here and talking first about index funds. And index funds are simply a form of mutual fund, which is basically just a pool of money that has been collected by outside investors. And that pool of money is then invested on their behalf into things like stocks and bonds by the actual managers of that fund. And so, as I said, index funds basically function in the same way. But the major difference here is that with an index fund, the portfolio or the way that pool of money is actually invested is done so in a way to simply track existing market indexes. And in case you don't know what market indexes are, or if you just need a refresher, I also have a YouTube video explaining exactly what they are and how they work, and I'll drop a link to that video in the description of this one below. And so if you do decide to invest in index funds, this is what will allow you to invest in things like the S&P 500, the Dow Jones, the NASDAQ, the Russell 2000, or other market indexes that will give you very broad market exposure and a great level of diversification. And these are the exact kinds of things you should be looking for when investing in the stock market, which is why index investing is one of the most popular forms of investing around. But ultimately, because these index funds are simply tracking existing indexes, they're very passively managed, which means the cost of actually running and maintaining these funds is very, very low. And that's a good thing because the costs of any fund, which come in the form of things like obviously paying the managers and the analysts and the other employees of that fund, as well as things like taxes, as well as transaction costs when those funds are making trades, those costs are always going to be passed on to the investors. But of course, if the fund is very passively managed and there's not a lot of overhead to maintain and run that fund, then like I said, the costs are going to be very low, which means you as the investor are going to keep a lot more of your profits. And if you are considering investing in index funds, I would personally recommend you take a look at the index funds that Vanguard has to offer. Vanguard index funds are some of the most popular around because, one, there are so many of them. You can invest in things like bonds, either short-term, medium-term, long-term, high risk, low risk. You can also invest in domestic equities like the S&P 500 or the NASDAQ, as I said. You can also invest in global stocks or global equities and many, many more. And then the second reason also is because the costs of those funds are some of the lowest that you can find. And specifically, when you are looking for the cost of the fund that you as the investor will have to pay, you should be looking for the expense ratio. And the expense ratio will likely be quoted as a percentage, and this is the amount that you'll have to subtract from your profits each year. Now for Vanguard index funds, you'll find that the expense ratio for the majority of those funds is right around 0.05%. And so this would mean that over 1 year, let's say that fund generated a 10% return, then you as the investor would get to walk away with a 9.95% return, right? That last 0.05% is simply the cost that you as the investor have to pay. But obviously that 0.05% is almost zero, so it's really not a big deal. And again, that's one of the main reasons why Vanguard index funds are so popular. So definitely check them out. And so now moving on to ETFs, and ETFs are extremely similar to index funds, except the major difference here is that these funds have actual shares that are traded on exchanges. So if you wanted to invest in these kinds of funds, instead of actually transferring money to that fund like you would for an index fund, with ETFs, you would simply go into your trading platform or onto the website of your broker and you would just buy shares of that fund, just like you would buying shares of any form of stock. And most ETFs simply track market indexes, which is why they're so similar to index funds in that they'll give you very broad market exposure and great diversification, and they're also very passively managed, which means their expense ratios are also very, very low. So using ETFs, if you wanted to invest in something like the S&P 500 in a very low cost manner, then you can just go into your platform and buy shares of SPY, for example. SPY is one of the most commonly traded ETFs in the world, and it simply tracks the S&P 500. But I would also recommend you take a look at the ETFs that Vanguard has to offer as well. Just like their index funds, Vanguard ETFs have some of the lowest expense ratios that you can find, and they have a huge variety of them. So if there's any index or specific market sector that you want to invest in, chances are Vanguard has an ETF that will let you do that. And so now, which one of these things, either index funds or ETFs, are going to be the best investment for you? And it really just comes down to how active you want to be in managing your investments. Right, with index funds specifically, this is the most passive way to invest in the stock market. You simply transfer money to the fund and then they do the rest. But on the other hand, with ETFs, you are the one who has to actually go into your trading platform or go into your broker's website and actually buy and sell shares of the ETFs that you want. But this will give you much greater flexibility and control over how you want to manage and construct your portfolio. Right, another major difference between index funds and ETFs is with ETFs, you can buy and sell shares of those funds whenever you want as long as the market is open. But with index funds, if you want to transfer money to that fund or pull your money out, you have to wait until the end of that trading day. And that transfer of money is going to occur at whatever the closing prices are for that day, whatever they may be. So with ETFs, you have much more immediate control over what's in your portfolio, and then you also, like I said, have much greater flexibility in how you want to construct your portfolio. Do you want to invest in the S&P 500? Okay, then buy shares of SPY. What about the NASDAQ? Just buy shares of QQQ. What about Mexico? EWW, Brazil, EWZ, gold, GLD, silver, SLV, so on and so forth. And if you want to see how to specifically combine different ETFs into a portfolio that was designed by Ray Dalio, one of the top hedge fund managers in the world, then you can check out my Skillshare course called the All Season Strategy. I'll drop a link to that one in the description of this video below. And so ultimately, index funds and ETFs are both going to give you a fantastic and low-cost way to invest in the stock market. But like I said, it's really just going to come down to how active you want to be in managing your investments. And that specifically will dictate which one you'll likely be choosing. Or maybe you'll decide to do a little bit of both. Either way, I hope this video gave you some things to think about and a good place to start. And so that concludes this video. I hope you enjoyed it. And again, if you would like to take some in-depth courses into stock market investing as well as options trading, then please check out my Skillshare courses, links in the description of this video. And lastly, if you enjoyed this video, please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. And make sure those notifications are turned on. I'll be dropping new videos every Monday, Wednesday, and Friday, and you don't want to miss out. So thanks again for watching, and I'll see you next time.